The jobs report came out this week, and I have been getting calls nonstop from journalists, from analysts, from old friends who want to know what I think. Everyone wants to know the same thing. Warren, what are you doing with your money now? Warren, does this change your outlook? Warren, should we be worried? Let me tell you exactly what I am doing with my money after this week's jobs report. And more importantly, let me explain why I am doing it. Because the actions themselves matter far less than the reasoning behind them. If you understand how I think about economic data, how I interpret signals from the labor market, and how I position portfolios for uncertainty, you will be far better equipped to make your own decisions than if I simply told you what stocks I am buying or selling. First, let me give you my honest reaction to the jobs report. It confirms something I have been sensing for months. The economy is at an inflection point. We are no longer in the easy money. Everything goes up environment that defined the years after the pandemic. We are also not yet in a recession despite all the predictions. We are in something more complicated, a transition period where the old playbook does not quite work and the new playbook has not yet been written. The labor market remains remarkably resilient by historical standards. Unemployment is still low. Employers are still hiring, though, at a slower pace. Wages are still growing, though not as fast as they were. If you had shown me these numbers 10 years ago without any context, I would have said this is a healthy economy. Nothing to worry about, but context matters enormously. These numbers come after the Federal Reserve has raised interest rates at the fastest pace in 4 decades. They come after an inverted yield curve that has historically predicted recessions with remarkable accuracy. They come after banking stress that reminded everyone how quickly confidence can evaporate. The fact that the labor market has held up this well, these headwinds, is genuinely surprising. It is either a sign of underlying economic strength or a sign that the pain is still coming and just has not arrived yet. I have been investing for over 70 years. I have seen every kind of economic environment imaginable, booms and busts, inflation and deflation, war and peace, panic and euphoria. And if there is one thing I have learned, it is that the economy is far more complex than any single data point can capture. Anyone who tells you they know exactly what will happen based on one jobs report is either lying or deluded. So what am I actually doing with my money? Let me walk you through my thinking. The first thing I am doing is maintaining a substantial cash position. Berkshire Hathaway currently holds over $300 billion in cash and short-term treasury bills. This is an enormous sum. It is more cash than we have ever held. And some people think I am crazy for sitting on all this money when I could be investing it. But here's how I think about cash. Cash is not just a place to park money while you wait for better opportunities. Cash is optionality. Cash is the ability to act when others cannot. Cash is what allows you to be greedy when others are fearful, as I like to say. When the 2008 financial crisis hit, I was able to make investments that generated billions of dollars in profits because I had cash available. I invested $5 billion in Goldman Sachs when they desperately needed capital. I invested $3 billion in General Electric. I bought preferred shares with terms that would never have been available in normal times. Those investments were only possible because I had cash when others did not. The jobs report this week did not change my view that maintaining liquidity is essential right now. We are in a period of elevated uncertainty. Interest rates are high and may stay high. Valuations on many stocks are stretched. The potential for disruption, whether from economic slowdown, geopolitical events, or financial stress, is real. In this environment, having cash is not a burden. It is a strategic advantage. Now, some people look at the cash I am holding and they calculate the opportunity cost. They say, Warren, you are earning maybe 5% on that cash. If you invested in stocks, you might earn 10%. You are leaving money on the table. And mathematically, they might be right in certain scenarios. But here is what they miss. The opportunity cost of holding cash is linear. You miss out on some returns, but the cost of being fully invested when a crisis hits is nonlinear. It is catastrophic. If a genuine buying opportunity emerges, the kind where wonderful businesses are available at 50 cents on the dollar and I have no cash to deploy, the missed opportunity would dwarf any returns I might have earned by being fully invested in normal times. So the cash stays. After this week's jobs report, the cash stays. I am not putting it to work just because the labor market held up better than some expected. I am waiting for opportunities that truly excite me. The second thing I am doing is being very selective about new investments. When I do deploy capital, I am demanding more than I would in a normal environment. I want wider margins of safety. I want clearer competitive advantages. I want businesses I understand so well that I can hold them through any economic scenario. The jobs report actually reinforced this approach. Here is why. If the labor market remains strong, the Federal Reserve has less pressure to cut interest rates. Higher rates for longer means valuations need to adjust. Stocks that were priced for a world of 0% interest rates need to reprice for a world of 5% interest rates. That repricing is still happening, and it creates both danger and opportunity. The danger is that many stocks are still too expensive. They have come down from their peaks, but they have not come down enough to reflect the new reality of higher rates. Investors who buy these stocks thinking they are cheap because they are down 30% from their highs may be disappointed. Down 30% from an absurd valuation is not necessarily cheap. The opportunity is that as this repricing continues, truly wonderful businesses will eventually reach prices that make sense. Patient investors who wait for these moments will be rewarded. Impatient investors who deploy capital too early will earn mediocre returns at best. I am in no hurry. The jobs report did not create urgency. If anything, it confirmed that we are in a transition period that will take time to play out. I can wait. The third thing I am doing is focusing on businesses that can thrive regardless of economic conditions. When the outlook is uncertain, when I do not know whether we are heading for a soft landing or a hard landing or something in between, I want to own businesses that will be fine either way. What does that mean specifically? It means businesses with pricing power. Companies that can raise prices without losing customers because what they sell is essential, or because their brand is so strong, or because switching costs are so high. These companies can maintain margins even if costs rise or demand softens. It means businesses with low capital requirements, companies that generate cash without needing to constantly reinvest. When the economy turns down, companies with high capital requirements face a brutal choice. They can cut investment and fall behind competitors, or they can keep investing and burn through cash. Companies with low capital requirements do not face this dilemma. It means businesses with strong balance sheets, companies with little debt and ample liquidity. When credit tightens, when borrowing costs rise, when lenders get nervous, companies with strong balance sheets can actually take advantage. They can acquire struggling competitors. They can invest when others are retrenching. Financial strength becomes a competitive advantage in tough times. It means businesses that sell things people need, not things people want. Discretionary spending gets cut when times get tough. People delay buying new cars, they skip vacations, they eat out less. But they still buy groceries, they still pay for health care, they still use electricity. Companies selling necessities are far more resilient than companies selling luxuries. The jobs report did not tell me which companies meet these criteria. It just reminded me why these criteria matter. We are in an environment where resilience will be rewarded and fragility will be punished. The fourth thing I am doing is paying close attention to what the labor market data reveals about inflation. This is something most investors overlook when they read the jobs report. They focus on the headline numbers. How many jobs were created? What is the unemployment rate? Is this better or worse than expected? But for investors, the inflation implications matter just as much. Wage growth is a critical input into inflation. When workers earn more, companies face higher costs. They pass those costs to consumers through higher prices, or they absorb the costs through lower profit margins. Either way, the impact on businesses and stock valuations is significant. This week's jobs report showed wage growth that remains elevated by historical standards. Workers are still gaining bargaining power in many sectors. Companies are still raising pay to attract and retain employees. This is good for workers, but it creates pressure on corporate profits, and it makes the Federal Reserve's job harder. And wage growth stays elevated. The Fed will be reluctant to cut rates even if other economic data softens. They will worry that inflation could reignite. Higher rates for longer is the base case that I am preparing for. That has implications for what I buy and what I avoid. Businesses with high labor intensity face the most pressure from wage growth. Retailers, restaurants, healthcare providers, manufacturers, any company where labor is a large percentage of total costs will see margins squeezed if wages keep rising faster than productivity. Businesses with low labor intensity or high automation potential are better positioned. Technology companies with relatively small workforces generating large revenues, software businesses where additional customers add almost no cost. Companies investing in automation to reduce labor dependency over time. The jobs report reinforced my preference for businesses that are not hostage to labor cost pressures. In an environment where workers have power and wages are rising, I want to own businesses that can thrive despite that dynamic, not businesses that will be squeezed by it. The fifth thing I am doing is thinking very carefully about duration. Duration, in the investment sense, refers to how far into the future the value of an investment depends on. A 30-year bond has long duration because its value depends on interest rates for 3 decades. A treasury bill maturing in 3 months has short duration because you will have your money back soon, regardless of what rates do. Stocks also have duration, though people do not usually think of it that way. A high-growth company with no current earnings but tremendous future potential has long duration. Its value depends entirely on what happens many years from now. A mature company generating large current cash flows has shorter duration. Much of its value comes from the cash it is producing right now. When interest rates rise, long-duration assets suffer the most. The present value of far future cash flows declines significantly when you discount them at higher rates. This is why growth stocks got crushed in 2022 when rates spiked. Their values were based on earnings expected 10 or 15 or 20 years in the future. Higher discount rates made those future earnings worth much less today. The jobs report this week suggested that rates may stay higher for longer than many investors hoped. The economy is not collapsing. The Fed does not need to rush to cut rates. The higher rate environment may persist. This has significant implications for portfolio construction. I am favoring shorter duration investments. Companies generating substantial cash flows today rather than promising cash flows far in the future. Companies with reasonable valuations based on current earnings rather than stretched valuations based on optimistic projections. I am not saying to avoid growth entirely. Some growth companies are wonderful businesses that will create enormous value over time. But I am saying to be very careful about the prices you pay for growth in a higher rate environment. The math has changed. Valuations that made sense when rates were 0 do not make sense when rates are 5%. The sixth thing I am doing is watching the banking sector very carefully. The jobs report itself does not say much about banks directly, but the labor market is intimately connected to credit conditions, loan performance, and financial stability. Banks make money by lending. When people have jobs and businesses are growing, borrowers can service their debts. Loan losses are low, banks are profitable. But when unemployment rises, when businesses struggle, when borrowers cannot pay, banks take losses, sometimes catastrophic losses. We saw earlier this year what happens when confidence in banks erodes. Silicon Valley Bank collapsed in a matter of days. Signature Bank followed. First Republic was seized. These failures happened not primarily because of loan losses, but because of interest rate risk mismanagement. But they reminded everyone how quickly a banking crisis can develop. The jobs report showing continued labor market strength is good news for bank loan portfolios in the near term. Borrowers who have jobs can make their payments. But I am watching for signs of stress beneath the surface: commercial real estate loans where property values have declined, consumer credit where delinquencies are rising, corporate loans to businesses that loaded up on cheap debt and now face refinancing at much higher rates. I own banks. Berkshire has substantial positions in financial institutions, but I am being very selective and I am watching closely. The banking system is not out of the woods yet. The combination of higher rates, commercial real estate weakness, and potential economic slowdown creates risks that could materialize suddenly. The seventh thing I am doing is staying humble about predictions. This is perhaps the most important thing. After every jobs report, after every economic data release, commentators rush to explain what it means and what will happen next. They speak with tremendous confidence about whether we will have a recession, when the Fed will cut rates, where the market is heading. I do not have that confidence. I have learned over 70 years that the economy is not predictable. Expert forecasters are wrong constantly. The consensus view is wrong constantly. Anyone who claims to know what will happen is fooling themselves and probably fooling you too. What I can do is prepare for multiple scenarios. I can position the portfolio to survive and ideally thrive regardless of whether the economy booms or busts. I can maintain flexibility to adapt as conditions change. I can avoid making bets that depend on specific predictions being correct. The jobs report this week was interpreted differently by different people. Some saw it as evidence that the economy is fine and recession fears were overblown. Others saw it as evidence that the Fed will keep rates high and eventually something will break. Both interpretations are plausible. Neither is certain. My response is not to pick a side and bet heavily on that outcome. My response is to build a portfolio that works across multiple scenarios, cash that provides optionality if opportunities emerge, high-quality businesses that can compound regardless of economic conditions, flexibility to adjust as new information arrives. Let me tell you a story that illustrates why I approach things this way. Back in 2000, the economy was booming. The stock market was at all-time highs. Unemployment was low. Everyone was optimistic. Then the dot-com bubble burst. Then the September 11th attacks happened. The economy went into recession. Stocks fell dramatically. The world looked completely different than it had just a year or two earlier. Then in 2006, the economy was booming. Again, housing prices were at all-time highs. Financial stocks were soaring. Unemployment was low. Everyone was optimistic. Then the housing bubble burst. The financial crisis happened. The economy went into the worst recession since the Great Depression. Stocks fell by more than half. The world looked completely different again. In both cases, the labor market was strong right before everything fell apart. Strong employment data did not prevent disaster. If anything, it created complacency. It made people think everything was fine when dangerous imbalances were building beneath the surface. I am not predicting that disaster is imminent now. I genuinely do not know what will happen, but I know that strong jobs data does not mean the coast is clear. It does not mean you should bet aggressively on continued prosperity. It does not mean you can abandon caution and go all in. The appropriate response to uncertainty is not prediction. It is preparation. It is building resilience. It is maintaining optionality. That is what I am doing with my money after this week's jobs report. Let me also address something that I think is underappreciated. The relationship between employment data and stock market returns. Many investors assume that good economic data leads to good stock returns. The economy is growing. Companies are making money. Stocks go up. It seems logical. But the historical relationship is much weaker than people expect. Some of the best stock market returns have come during recessions and periods of high unemployment because stocks had gotten cheap and expectations were low. Some of the worst stock market returns have come during economic booms because stocks had gotten expensive and expectations were too high. What matters for stock returns is not whether the economy is good or bad in absolute terms. What matters is whether reality is better or worse than what is already priced into stocks. If everyone expects a recession and the recession is milder than feared, stocks can soar even though the economy is contracting. If everyone expects continued prosperity and growth merely slows, stocks can crash even though the economy is still growing. This is why I never make investment decisions based on economic forecasts. Even if I could correctly predict whether unemployment would rise or fall, that prediction would not reliably tell me whether stocks would go up or down. The market's expectations matter as much as the actual outcomes. After this week's jobs report, expectations have adjusted. Markets have partially priced in a soft landing scenario where the economy avoids recession despite higher rates. If that optimistic scenario unfolds, stocks may do okay from here. But if the soft landing does not materialize, if the delayed effects of rate hikes finally bite, the downside could be significant because people are not positioned for it. I would rather be prepared for the downside and miss some upside than be positioned for continued prosperity and get crushed when reality disappoints. Now let me talk specifically about what sectors and types of businesses look most attractive to me in the current environment. This is where the rubber meets the road. Energy remains interesting to me. Oil and gas companies are generating tremendous cash flows. They have cleaned up their balance sheets after years of capital discipline. They are returning capital to shareholders through dividends and buybacks, and the supply-demand dynamics for energy remain favorable. Years of underinvestment in new production mean that even moderate demand growth could tighten markets. The jobs report actually supports the case for energy. A resilient economy means continued energy demand. Factories keep running, trucks keep delivering goods, people keep driving to work. If we were heading into deep recession, energy demand would fall. The strong labor market suggests demand will hold up. Insurance is another area I find attractive. Our insurance operations at Berkshire have been performing exceptionally well. Pricing in property and casualty insurance has been strong after years of inadequate rates. Investment income on the float has risen dramatically now that interest rates are higher. Well-run insurance companies can compound wealth at attractive rates with relatively low risk. Consumer staples deserve attention. Companies selling food, beverages, household products. These businesses are not exciting. They do not have explosive growth, but they have remarkable stability. People keep buying toothpaste and laundry detergent and breakfast cereal regardless of economic conditions. In an uncertain environment, that stability is valuable. I am more cautious on areas that depend heavily on continued economic strength and consumer confidence. Luxury goods, travel and leisure, cyclical manufacturing, housing-related businesses. These sectors could do fine if the soft landing materializes, but they would suffer significantly if we get the hard landing that many have been predicting. I am also cautious on the most speculative areas of the market. Companies with no earnings trading at astronomical valuations based on stories about future potential. Cryptocurrencies, meme stocks. These are not investments. They are speculations. And speculations tend to end badly when financial conditions tighten and investors become more discriminating. Let me close with some thoughts about what all of this means for individual investors. You are probably not managing hundreds of billions of dollars like I am. You probably do not have teams of analysts studying every economic data release. But the principles I am applying can work for you too. First, do not panic and do not chase. The jobs report did not fundamentally change the investment landscape. It was one data point among thousands. Making dramatic portfolio changes based on a single economic release is almost always a mistake. Stay calm. Think long-term second. Maintain some liquidity. Having cash available when opportunities arise is valuable for individual investors, just as it is for institutional investors. You do not need to be fully invested at all times. Having some dry powder is prudent. Third, focus on quality in uncertain times. Owning excellent businesses matters more than ever. Companies with strong competitive positions, solid balance sheets, and capable management can navigate whatever environment emerges. Speculative junk tends to get exposed when conditions tighten. Fourth, do not pretend you can predict the economy. I cannot do it after 70 years. Professional economists cannot do it. You probably cannot do it either. Make decisions that work across multiple scenarios rather than decisions that depend on specific predictions being correct. Fifth, keep buying if you are still accumulating. If you are in the wealth building phase of life, regular contributions to a diversified portfolio through dollar cost averaging is almost always the right approach. Trying to time the market based on economic data is a loser's game. Just keep investing steadily regardless of what the jobs report says. Six, avoid leverage in a higher interest rate environment with elevated uncertainty. Borrowing to invest is especially dangerous. The interest costs are higher. The risk of margin calls if markets decline is real. Stay conservative with debt. What am I doing with my money after this week's jobs report? I am staying patient. I am maintaining liquidity. I am focusing on quality. I am preparing for multiple scenarios. I am avoiding the temptation to make predictions or chase short-term moves. This is not exciting advice. It is not the kind of dramatic action that makes for good headlines, but it is the approach that has served me well through every economic environment for over 7 decades. It is the approach that will serve me well through whatever comes next. The jobs report will be forgotten in a few days. Another economic release will capture everyone's attention. Commentators will again explain with great confidence what it means and what will happen. The cycle will repeat. But the fundamentals of good investing never change. Buy quality businesses at reasonable prices. Hold them for the long term. Maintain the financial and emotional resilience to stay the course through volatility. Do not pretend to know things you cannot know. That is what I am doing with my money. Not just this week, every week. Let me go deeper on something I touched on earlier, because I think it deserves more attention. The question of when to deploy the cash I have been accumulating. People constantly ask me what I am waiting for, what signal would cause me to put this money to work. The honest answer is that I am not waiting for a specific signal. I am not watching unemployment rates or GDP growth or Federal Reserve statements waiting for some trigger that tells me now is the time to buy. That approach does not work because by the time any signal is clear enough to act on, the opportunity is usually passed. What I am waiting for is value. I am waiting for businesses I understand and admire to reach prices that make me excited to own them. Prices where the potential returns are compelling relative to the risks. Prices where even if things go wrong, I am unlikely to lose money permanently. Those prices are not widely available right now after a decade of low interest rates and abundant liquidity. Most assets got expensive. The 2022 decline helped but did not fully reset valuations. Many stocks are still priced as if interest rates will return to zero and growth will resume at prior rates. I do not think that is realistic. So I wait not passively. I am constantly analyzing businesses, updating my understanding, refining my views on what I would pay for various companies. When prices reach my targets, I will act decisively, but I will not lower my standards just because waiting is uncomfortable. This discipline has served me well throughout my career. In the late 1960s, I closed my investment partnership because I could not find enough attractive opportunities. People thought I was crazy. The market kept going up after I stepped aside. But then the brutal 1973 to 74 bear market arrived and stocks fell by nearly half. My patience was vindicated. In the late 1990s, I avoided technology stocks entirely because the valuations made no sense to me. People thought I was a dinosaur who did not understand the new economy. Then the dot-com bubble burst and technology stocks lost 80 or 90% of their value. My patience was vindicated again. I am not predicting that a crash is coming now. As I said, I cannot predict these things, but I am maintaining the same discipline that has always worked. I will not chase expensive stocks hoping they get more expensive. I will not abandon my valuation standards because everyone else seems comfortable paying any price. The jobs report did not change the valuation landscape. Stocks did not suddenly become cheap because unemployment held steady. The prices are what they are, and at current prices, for most stocks, the prospective returns do not excite me. Let me also expand on something else I mentioned, the commercial real estate situation and why I am watching it so closely. This is one of the most significant risks in the current environment, and it relates directly to the employment picture. Commercial real estate, particularly office buildings, is experiencing a structural shift that goes beyond normal economic cycles. The pandemic changed how people work. Millions of employees discovered they could do their jobs from home. Many prefer it. Many companies have adopted hybrid arrangements where workers come to the office only a few days per week. This means demand for office space has declined permanently, not temporarily, permanently. Companies are not going to go back to needing as much space as they had before. They are letting leases expire. They are downsizing when they do renew. Vacancy rates in many cities are at or near record highs. The problem is that office buildings were financed based on the old demand levels. Owners borrowed money assuming they would collect certain rents from certain occupancy rates. Now rents are falling and occupancy is down. Many buildings cannot generate enough income to service their debt. Over the next few years, hundreds of billions of dollars in commercial real estate loans will need to be refinanced. The buildings are worth less than when the loans were made. Interest rates are higher than when the loans were made. Many of these refinancings will fail. Owners will default. Banks will take losses. The jobs report connects to this because commercial real estate depends on employment patterns. If companies keep hiring and eventually call workers back to offices, demand might stabilize. If companies cut jobs and reduce space needs further, the problem accelerates. This week's jobs report was modestly positive for commercial real estate in the sense that employment held up, but it did not solve the underlying problem. The structural shift to remote work is not going away because unemployment stayed low for another month. The commercial real estate crisis is still unfolding in slow motion. I am watching which banks have the most exposure to commercial real estate loans. I am watching which property owners are most leveraged. I am watching for signs that the stress is spreading. This could become a major source of financial instability if it is not managed carefully, or it could be absorbed gradually without systemic impact. I genuinely do not know which outcome we will get. But this uncertainty is another reason why I am maintaining liquidity. If commercial real estate stress triggers broader financial problems, there may be exceptional buying opportunities. If it gets resolved without broader contagion, I have lost nothing by being patient. The optionality of cash is valuable precisely because I cannot predict how this will unfold. I want to discuss one more aspect of my current thinking, the importance of business quality in an environment where easy money no longer papers over problems. During the era of zero interest rates and quantitative easing, almost everything went up. Good businesses went up. Bad businesses went up. Speculative ventures with no profits went up. The tide lifted all boats. It was hard to distinguish between genuinely great companies and mediocre ones riding the wave of cheap money. That era is over. Money is no longer free. Capital has a cost. Investors are becoming more discriminating. Companies can no longer grow by acquiring competitors with cheap debt and hoping synergies materialize. Startups can no longer burn cash indefinitely while waiting for profitability. The chickens are coming home to roost. In this environment, the gap between great businesses and average businesses will widen companies with real competitive advantages. Genuine pricing power, loyal customers, and efficient operations will thrive. Companies that were sustained by cheap financing and speculative enthusiasm will struggle. This is actually healthy. It is a return to normal for most of economic history. Capital was scarce and had to be allocated carefully. The zero interest rate period was the anomaly, not the norm. Now we are returning to an environment where business fundamentals matter, where profitability matters, where balance sheet strength matters. I welcome this return to normalcy. It favors the kind of patient, value-oriented investing I have always practiced. It punishes the speculation and financial engineering that was rewarded when money was free. The strong jobs report did not change this dynamic. If anything, by suggesting rates will stay higher for longer, it reinforced it. The businesses I want to own are businesses that will prosper regardless of the interest rate environment. Businesses that do not depend on cheap financing to grow. Businesses that generate enough cash to fund their own expansion and return capital to shareholders. Businesses that will be stronger 10 years from now than they are today. When I find these businesses at reasonable prices, I buy. When I cannot find them at reasonable prices, I wait. The jobs report did not change what I am looking for. It did not change my standards. It just provided one more piece of information as I continue to survey the landscape for opportunities. Let me leave you with a final thought about temperament. Investing success depends far more on temperament than on intelligence. I have known brilliant people who failed at investing because they could not control their emotions. They panicked when markets fell. They got greedy when markets rose. They made decisions based on fear and excitement rather than analysis and discipline. The jobs report will cause some people to change their behavior. Some who were worried about recession will now become more aggressive. Some who were optimistic will now find reasons to worry about inflation or interest rates. The news creates emotional reactions that drive trading decisions. I try to be immune to these emotional swings. I read the jobs report with interest. I update my mental model of the economy, but I do not let it change my investment approach. My approach is based on principles that transcend any single data release. Quality, value, patience, resilience. These principles do not change because unemployment was 0.1% higher or lower than expected. The investors who succeed over the long term are those who can maintain this equanimity. They do not get too high when things are going well. They do not get too low when things are going poorly. They just keep doing the right things day after day, year after year, regardless of what the news says. That is what I am doing with my money after this week's jobs report. The same thing I was doing before it, the same thing I will be doing next month and next year. Owning great businesses, maintaining financial strength, waiting patiently for opportunities, ignoring the noise and focusing on what matters. The jobs report was one piece of information, just one. In the grand scheme of a multi-decade investment journey, it is barely a footnote. What matters is getting the big things right, owning quality, avoiding permanent losses, compounding patiently over time. Those fundamentals do not change based on any economic data release. They are eternal principles that have built fortunes for generations of patient investors. They are what guide me now, and they are what will guide me for as long as I am investing.